Picture this. You wake up one morning, open your banking app, and your account balance is exactly what it was the night before. Your savings are right there. Every dollar, every cent. You close the app and make coffee. Life is normal. Now imagine you open that same app the next morning, and you can't log in. You drive to your bank. There's a line around the block, and a sign on the door that says, "Withdrawals are suspended until further notice." That is not a movie. That has happened. Multiple times. To real people who thought the same thing you probably think right now, that can't happen here. This video is about what actually happens to ordinary people's savings when a government's finances collapse. Not in theory, not in economics textbooks, in real streets, with real families, in 4 countries that lived through it. And as you'll see, the details are stranger, more brutal, and more instructive than most people realize. Let's get into it. Argentina, December 2001. The country had spent most of the 1990s pegging its peso to the US dollar, 1-to-1, which created an illusion of stability while debt quietly piled up behind the curtain. By 2001, Argentina's public debt-to-GDP ratio had risen rapidly, from 35% in 1995 to nearly 65% in 2001. The government kept borrowing, the IMF kept lending, and ordinary Argentines kept depositing their money into banks, many of them in dollars, trusting the system. Then, on December 1st, 2001, Economy Minister Domingo Cavallo announced what would become one of the most infamous economic measures in modern history. Informally known as the corralito, the Spanish word for a small enclosure like a child's playpen, the measures limited cash withdrawals to 250 pesos per week. At the time, 1 peso equaled $1. So you could take out $250 a week from your own money. That was it. Think about what that means for a family. Savers screamed and shouted for the return of their money blocked in the banks. "Choros, choros, devuelvan los ahorros." Thieves, thieves, give back the savings, people chanted loudly as they hammered on the lowered shutters of banks across the country. The human cost was immediate and personal. One computer scientist later recalled, "Of the $77,000 I had in the bank, I lost $40,000 in the corralito." This was a middle-class professional, someone who had done everything right. Saved money, kept it in a bank, trusted the system. He lost more than half. But here's the thing that gets worse. The freeze itself wasn't even the most devastating part. In addition to the corralito, the government dictated what became known as the pacificación. All bank accounts denominated in dollars would be converted to pesos at an official rate. Deposits would be converted at 1.40 pesos per dollar. Sounds reasonable, right? Except that the actual market exchange rate then collapsed. The exchange rate reached nearly 4 pesos per dollar, and accumulated inflation since the devaluation was about 80%. So someone who had $10,000 in a dollar account got converted to 14,000 pesos, which could then only buy what $3,500 used to buy. In one administrative stroke, the government had taken more than half the real value of dollar savings from ordinary people. And there's something else. It was probably clear to bank owners and high-ranking officials that Argentina's banking system was going to crash. Some, in fact, may have spurred this outcome by letting their highest deposit holders know this news. These, mostly large companies, quickly moved their deposits abroad. Meanwhile, they continued to recommend their middle-class customers to enter deposits. The politically connected got out. Ordinary people didn't. On the last day of 2001, Argentina defaulted on $81.3 billion of sovereign debt with private creditors, the largest sovereign debt default up to that point. 5 presidents came and went in 10 days. The 2001 crisis erased years of economic progress. Argentina's GDP in absolute terms by 2002 was only slightly higher than it had been 20 years earlier. The proportion of Argentines living below the national poverty line rose from a peak of 25.9% in 1998 to 57.5% in 2002. The lesson from Argentina isn't just about bad government. It's about what happens when a government's need to survive politically overrides its obligation to protect the people it governs, and when information asymmetry means the powerful escape while the trusting are left holding the bag. If Argentina showed you what it looks like when a government freezes your savings, Zimbabwe shows you something even more primal. What it looks like when your savings are technically still there, in your account, in cash, and they are worth absolutely nothing. Zimbabwe's hyperinflation crisis is the kind of story that sounds like satire until you understand it really happened. It started with a series of economic shocks in the late 1990s and early 2000s, controversial land reforms that devastated agricultural output, international sanctions, and a government that responded to every financial problem the same way, by printing more money. In June 2008, the annual rate of price growth was 11.2 million%. The worst of the inflation occurred in 2008, with the peak month occurring in mid-November 2008, reaching an estimated 79.6 billion% per month. That is not a typo. 79 billion% monthly. What did that actually look like for the person on the street? People had to spend time adjusting prices, but more importantly, they had to get rid of Zimbabwean currency as soon as they received it. Salaries became meaningless as they were eroded by inflation almost immediately. Savings were wiped out, pensions became worthless. People who had spent decades building a retirement nest egg watched it evaporate in weeks, not because the bank collapsed, not because the government took it, but because the currency itself ceased to function as a store of value. By late 2008, inflation had risen so high that ATMs for one major bank gave a data overflow error. They simply couldn't display numbers with enough zeros to represent the account balance. The machines weren't designed for sums this large because no one had imagined a world where they'd be necessary. The government's response to each new escalation was to print a larger note. They issued a $100 million note, then a $100 billion note. Then, and this is real, a $100 trillion note circulated briefly in 2009, the most zeros of any legal tender ever printed. And it was worth about 0.40 USD at the time it was issued. People's savings became worthless. Banks folded as their loan books diminished in value and there was no money to circulate when people stopped making deposits. The survival strategies people developed were extraordinary. Those who had foreign currency, especially the US dollar, could maintain some purchasing power. But the government imposed foreign exchange controls, making it illegal to transact in foreign currency even as the local currency collapsed. The government declared inflation illegal in 2007. Anyone who raised the prices for goods and services was subject to arrest, so prices were technically frozen by law, while the currency lost 99.9% of its value. Shelves emptied. A black market economy took over. Eventually, in 2009, the government had no choice but to abandon the Zimbabwean dollar entirely and allow transactions in foreign currencies. Hyperinflation ended almost overnight, but the savings of a generation were already gone. Zimbabweans still remember the horrific hyperinflation that destroyed their savings and turned their economy upside down. This, after all, was Zimbabwe's sixth attempt since 2008 to create a stable currency of its own. The trust broken in those years has never fully been rebuilt. Zimbabwe is the extreme version of something that's happened in milder forms across dozens of countries throughout history. A government uses the printing press to monetize its debt, and the cost is silently extracted from the savings of its citizens through inflation. It's a tax that doesn't require a vote. It doesn't even require an announcement. It just happens. Greece tells a different kind of story. Not a sudden freeze, not a hyperinflationary collapse, but a slow, grinding, methodical destruction of living standards. It played out over 5 years in 12 rounds of austerity measures. And in many ways, it was more psychologically brutal because it never felt like it was over. By 2010, Greece's debt burden had created a house of cards so that any economic dip could topple its precarious status quo. The global financial crisis was that dip. The crisis led to a loss of confidence in the Greek economy, indicated by a widening of bond yield spreads and rising cost of risk insurance compared to other Eurozone countries, particularly Germany. The key difference from Argentina and Zimbabwe is that Greece was part of the Eurozone. It couldn't devalue its currency, it couldn't print money. It was locked into an economic system designed for stability, and that same system now became the mechanism of austerity. The bailouts came from the International Monetary Fund, the European Central Bank, and the European Commission. But they came with conditions, 12 rounds of them. Between 2010 and 2016, 3 memoranda of economic cooperation were implemented, which included cuts in public employees' salaries, cuts in pensions for the elderly, and reduced minimum wage levels. The minimum wage for most workers dropped from €751 to €586. For workers under 25, it fell to €490. And pensions, the retirement savings and income of people who had worked their entire lives in the expectation of a stable retirement, were cut repeatedly. Monthly pensions above €1,200 were cut by 20%. For retirees under 55 years old, the pension over €1,000 was cut by 40%. Greece's economy collapsed. Its economic output declined by 25% from the 2010 level. Wages and pensions fell. Unemployment reached 27%. For young people, that number was even higher, at one point reaching over 50%. But here's the part that rarely makes it into the headline summaries. Among the biggest winners were foreign banks, who, at the outset of the crisis, found themselves holding a large proportion of Greek debt. By December 2011, they had slashed their exposure from $252.1 billion in June 2010 to $35 billion. The foreign banks got out before the haircuts arrived. Greek pension funds and ordinary bondholders absorbed the losses. Then came 2015, the moment of peak crisis. The Syriza government came to power, refused to accept a third set of austerity conditions, and called a referendum. Greeks voted no. After a popular referendum which rejected further austerity measures required for the third bailout, banks across the country closed for several weeks. Capital controls were introduced. Greeks could only withdraw 60 euros per day from ATMs. Businesses couldn't pay suppliers. People couldn't access their savings above that limit. Once again, those who had moved money out of the country beforehand were fine. Those who trusted the system, who kept their savings in Greek banks, who couldn't or didn't move money in time, they were trapped. The average purchasing power of Greeks fell from 84% of the EU15 average to 65%. Between 2008 and 2015, 427,000 Greeks emigrated, the great majority of them university educated. An entire generation left. They took their education, their skills, and their economic potential with them, a human cost that doesn't show up on any balance sheet. Of all four cases in this video, Lebanon may be the most chilling, because it's still happening right now in 2026, and it still hasn't been resolved. Lebanon's financial system had a fundamental structural problem for decades. The government ran chronic deficits, borrowed heavily at very high interest rates, and the central bank ran what multiple international institutions, including the World Bank, the United Nations, and France, would later describe as a Ponzi scheme. The central bank created incentive schemes for commercial banks to deposit their clients' funds in exchange for exceptionally high and immediate returns, sometimes reaching 35%. While the central bank justified these operations as a way to bolster foreign currency reserves, the outcome was staggering. It burned through tens of billions of dollars paying bankers' profits, with depositors ultimately footing the bill. The collapse began in October 2019. Following large demonstrations, Lebanese commercial banks closed for an unprecedented 2 weeks. When they reopened, commercial banks unlawfully restricted depositors' access to their own money in US dollar, despite no official capital control. There was no law authorizing what the banks did. They just did it, and the government let them. Lebanon's currency, the Lebanese pound, has lost more than 98% of its value since 2019. 98%. If you had $100,000 worth of savings in Lebanese pounds at the start of 2019, the equivalent purchasing power by 2024 was roughly $2,000. For those who held dollar accounts, the situation was only marginally better, because the banks were restricting dollar withdrawals to roughly $400 per month. In early 2020, while banks were denying ordinary depositors transfers, and withdrawals were restricted to approximately $400 per month. The central bank extended loans worth $8 billion to 15 Lebanese banks. The insiders were protected. Ordinary depositors were not. The desperation became so profound that some depositors took matters into their own hands. Lebanese depositors resorted to armed robbery as the only way to extract their own money from banks. They weren't stealing anyone else's money. They were staging holdups to access their own savings, and Lebanese society broadly sympathized with them. People saw these depositors as modern Robin Hoods taking matters into their own hands. The total value of frozen depositor funds in Lebanon banks as of early 2025 is estimated between $86 billion and $93 billion, spread across approximately 1.26 million old accounts. 6 years into the crisis, most of that money has still not been returned. Customer deposits fell from $172 billion in 2009 to $88 billion in 2024. Parents are sending their children to orphanages because they cannot feed them. The Lebanon that was once called the Paris of the Middle East, a regional financial hub with a sophisticated banking sector, is still, right now, trying to figure out how to return people's savings to them. And there is no guarantee it ever will. These aren't random disasters. They share patterns that matter enormously for understanding risk. First, the people who got hurt were almost always the ones who trusted the system. In Argentina, the middle class kept their savings in banks, while insiders moved money offshore. In Greece, foreign banks reduced their Greek bond exposure before haircuts arrived. In Lebanon, the politically connected moved funds abroad before capital controls came. In every case, ordinary depositors, the ones who followed the rules, absorbed the losses. Second, governments have multiple ways to take value from savings, and most of them aren't called taking. They can freeze withdrawals. They can forcibly convert your currency at unfavorable rates. They can inflate away the purchasing power of what you hold. They can cut pensions. They can impose capital controls that trap money inside a collapsing system. None of these are called confiscation, but they function the same way. Third, the warning signs existed in every single case before the crisis hit. Argentina had a debt-to-GDP ratio rising fast. Greece was falsifying its deficit numbers. Zimbabwe's money supply was visibly expanding. Lebanon's central bank was offering 35% returns, which, if you understand finance at all, is not a sign of health. It is the signature of a system that has to overpay to survive. And fourth, globally, debt service costs rose to 3.3% of GDP in 2024, up from 2.4% in 2021, amounting to more than $2 trillion. The value of outstanding government and corporate bonds in the Organization for Economic Cooperation and Development exceeded $100 trillion last year. these are not abstract numbers. They represent the size of the obligations governments around the world are carrying into a future of higher interest rates and slower growth. None of this means what happened in Argentina, Zimbabwe, Greece, or Lebanon is about to happen in your country. But it does mean that understanding what happened in those places, and specifically what it meant for ordinary savings, is not just an exercise in history. It is a form of financial literacy that most people never get, because it is uncomfortable, and because the stories don't end neatly. The safest thing you can do with this knowledge isn't to panic, it's to think clearly, diversify, and never assume that because something hasn't happened yet, it can't happen at all. Because every one of the people who woke up to a locked bank, or a worthless note, or a 40% pension cut, or $400 monthly withdrawal limit, every one of them had also believed, until the day it happened, that their savings were safe. If you found this video useful, consider sharing it with someone who's never thought about these risks. The more clearly people understand history, the better prepared they are for whatever comes next. We'll see you in the next one.